Friends, welcome to the fourth lecture of financial management. Today we'll talk about financial management, which essentially is about the trade-off. The word that is key is trade-off between risk and return. Now, what exactly do we mean by trade-off? Trading off means you are utilizing certain concept so that you want to derive something out of it, right? For example, if I'm using my eyeglasses for seeing things better, that is its utility, right? Now, instead of to see better, if I'm using glasses for something else, right? Like, for example, getting the sun rays pass through this lens so that I can generate heat. What I'm doing, I'm trading off the benefit of using the glass for generating heat instead of using something else, instead of using a thing for its stated purpose, other than using things other than for stated purpose, is what we call it as trade-off. Now, financial management is a trade-off. Financial management, like yesterday we have talked about, why do you manage finance? So that profits are maximized. So instead of thinking of only maximizing the profits, we are talking about minimizing risk and maximizing returns. Minimization of risk and maximization of profits. So it's generally this we keep on talking about time and again throughout the course of this study of this subject. Always we'll be talking in terms of minimizing risk and maximizing returns. So financial management is essentially a trade-off between risk and returns. If the risks are going high, definitely the returns will come down. And if you want to enhance the returns, definitely you have to take care of risk on the lower side. So this essentially is what we are dealing with financial management, the aspect of financial management. Today we'll talk about its scope. We'll talk about its scope with respect to financial management. Okay. Now, what exactly is included in financial management scope? There are three decisions normally which are taken in financial management. Primarily, these decisions are taken again to minimize risk and maximize returns. The decisions being investment decisions, financing decisions, and dividend policy decisions. Now, what exactly do we mean by investment decisions? If you look closely, investment decisions are allocation of funds for investment in assets and other activities. Now, when you say assets, what are assets? Assets are predominantly, if you see very closely, these are resources Assets are resources having economic value. They have economic value, not only financial value. Take care of the words. Assets are resources having economic value. Of course, assets are measured in financial terms. Assets are measured in monetary terms, not financial terms, but monetary terms. These are resources having economic value, employed in the business for maximizing, again, returns. So, investment decisions related with allocation of funds for investment in assets and other activities. These are the decisions that are related with investments. What do you do in investment decisions? You talk about allocation of funds. Funds raised, what are the sources? If they can be raised, the capital can be raised, or own profits they are pluffed back into the business. Means whatever profits you are generating, you are putting it back into the business. That's what we call it as allocation of funds. From either you raise the capital from the market by issuing shares, debentures, bonds, or if you take loans, or you're putting it back your own profits back into the business. Whatever decisions you take in purview of allocation of funds for investment in assets is what we call it as investment decisions. Here, investment decisions. Now, investment decisions can be short-term in nature, right? Can be short-term in nature and as well as long-term in nature. Now, what are the short-term decisions related with current assets management or working capital management decisions? Now, earlier we had talked about what are assets, right? If you see closely here on top, we talked about assets. Now we are talking about current assets. Now, what are current assets? Resources here. Assets or resources. Resources which are easily convertible into cash. Examples: raw materials or finished goods. Any decision that is related with current asset management means whether to convert that into cash, whether to convert raw materials into cash, or whether to convert finished goods into cash, or working capital management. Now, what is working capital management? Those funds which are required on a day-to-day basis is what we call it as working capital. If you remember in your graduation days, we used to have two types of capital. One was fixed, the other is working. Fixed is used for buying land, machinery, right? Working capital is used for making payments to labor, buying raw materials, expenses, right? These are what we call it as working capital. So, any investment decision that is related with working capital management is what we call it as short-term decisions. Now, what are long-term investment decisions? They are related with capital budgeting or capital expenditure. Now, what is capital budgeting? Capital budgeting is related with selection of an asset, investment proposal, and its course of action. Why we are talking about selection of an asset, investment proposal, or course of action is because the benefits are likely to be available in future over the lifetime of a project. In other words, put it simply, you start a business, you employ capital, right? By selecting an asset, by selecting an investment proposal and deciding how to earn the business, how to run the business, simply for the simple reason that you anticipate benefits. You anticipate benefits which are likely to occur or accrue in future till the existence of the lifetime of a project, right? Those are long-term decisions. Now, these decisions are what we call it as capital budgeting decisions, or long-term decisions are also those decisions which are related with capital expenditure. Now, capital expenditure means whether you want to buy a land, whether you want to buy a plant and machinery. We do capital expenditure simply for the enhancement of returns, right? Now, returns can be categorized as profits and share value. Enhancement of this arrow indicates enhancement on the higher side, enhancement of profits and share value. Now, long-term investment decisions also involve higher amount of risk, right? Because when you say long-term, it is generally decisions that are taken for the benefits which are going to be accrued for more than 1 year. These are decisions that are taken for deriving benefits which you are going to get for a longer period of time. That is the reason why it's called as long-term investment decisions. Now, the second perspective of financial management is financing decisions. Now, what is financing decision? It's concerned with financing mix, capital structure, and leverage. Right? Now, when you say financing mix means where from and how you are going to raise capital. Where from and how. This is included in financing mix. Now, what is capital structure? Capital structure determines the key words here, my dear students. Composition and proportion of different sources of capital. Now, what are different sources of capital? Shares, debentures, bonds, loans. These are different sources of capital or different types of capital, right? How much should be the share equity or how much should be the loan percentage of the total capital? Now, this structure, this reflects the total capital in the business. It may be in the form of shares or debentures or bonds or loans. You raise capital through shares, during the course of a business at certain times. That we'll study in later on. Now, when to raise money or when to raise capital through shares or debentures or bonds or loans, the timing of raising capitals or the timing of raising the different types of capital, that we'll study later on. To put it simply, capital structure determines the composition, whether you need to have all the four aspects of types of capital or proportion, how much should be each. Say for example, out of 100%, how much you're talking about shares, how much you're talking about debentures, how much you're talking about loans, how much you're talking about bonds. So this is what we call it as proportion, right? So financing decision involves concern with financing mix, capital structure and leverage. This is the point that we are going to study in depth later on. Now, what's leverage? It's a mechanism to decide the optimum capital structure. How we are going to decide this, right? Optimum capital structure, optimum. Now, optimum forms can be many. Like you are going to talk about raising capital through shares, debentures, bonds, or loans, right? Now, how much should be this in percentage and proportion terms? There's a mechanism, right? There's a mechanism. It's called as leverage mechanism to decide the optimum capital structure. Now, why do you want optimum capital structure? Is, put it simply, for profit maximization and wealth maximization. Okay. The third decisions that need to be taken in the realm of financial management is with respect to dividend, right? Now, dividend comes from the word divide. Now, what are you dividing? You are dividing profits, or put it simply, returns. You have undertaken a risk to get returns. This is what we call it as dividend. Now, decisions with respect to dividend deal with two scenarios. Scenario one, should the profits be distributed, distribution of profits, or should they be retained? Now, whenever you are distributing profits, it involves cash outflows. Definitely, cash is going to flow out of the business, right? So, what happens in that case? If cash goes out, cash going out in financing terms means lesser liquidity that is available for running the business. Lesser liquidity. This is the scenario if the cash goes out. Or, in other words, dividend decisions also relates to the decision whether the profits that you have earned, should they be retained. Now, whenever you retain, you are going to incur cost. Now, what is the cost here? If you keep back the money that you owe to somebody, you incur a cost. That is what we call it as interest cost. What is the cost that you incur? Interest is the cost that you need to pay whenever you withhold the money that you owe to your shareholders, right? So, what should we do? Whether we should distribute the profits or retain the profits. This decision, or for that matter, all these three decisions, what are they? The three decisions: investment decisions, financing decisions, and dividend decisions. These three decisions depend upon, if you remember the concept, depend upon the business cycles. Now, business cycles are again dependent on the economy of a given country, right? So that is the reason why we were studying the relationship between economy, finance, and accounting, right? That was the reason why we are talking about. If you remember yesterday's lecture, we had talked about the impact of economy environment on the financial environment of the firm, right? So financial environment of the firm is going to affect the accounting environment of the firm, that we have discussed. So all these three decisions, investment decisions, financing decisions, and dividend decisions, are taken into consideration in financial management. Thus, financial management is related with or concerned with capital optimization, leading to profits and wealth maximization. In a nutshell, what you are going to do, if you want to put it in one single line to understand better, financial management is related with capital optimization. Whatever money you raise for the purpose of doing business, how you are going to utilize it so that they lead to profits and ultimately leads to wealth maximization. Profits for the owner and wealth maximization for the shareholder, right? So always remember, this you are doing, financial management you are doing with the sole purpose of optimum utilization of the available capital, right? Optimum utilization of the available capital. Of course, the capital can be of your own or from different sources. If it is of your own, then you will be talking about your own profits. If it is you're raising capital from different sources other than your own money, that you need to talk about maximization of wealth. So always is dealing with financial management is always dealing with capital optimization. So dear friends, this simply a summary of what could be the perspectives of financial management, how we are going to talk about financial management. So if you want to understand financial management, you got to understand risk perspectives, return perspectives, and decisions. And for that matter, whatever subjects we are talking about in management educations, again I'll come back to the point that we are doing MBA so that our decisions are better. This is the sole reason why you are undertaking management education, simply to make your decisions better. Decisions with respect to finance, marketing, HR, production and operations, IT. These are what? These are functions of management. So here we are talking about taking decisions better in the realm of or from finance perspective. So that's all for now. Thank you.